All right. Good morning, good afternoon, good evening, ladies and gentlemen. Welcome back. It is Friday, 21st of August, and I think the stock market is trying to go green, trying to end the week green after what has been a pretty volatile week. I think we are seeing oil prices at around $87 per barrel, but after what Scott Bessent tried to pull in the last couple of days, all of that has been basically undone now, right? The US 10-year is back to 4.7, US 5-year is back to 4.4. I think that when he tried to intervene with the markets, obviously markets didn't like it. And I would presume that caused bonds to continue to re-rate, right? Because now people have to price in the additional risk of um, intervention by the government, and that is not something people want to see. So we'll be talking a little bit about that. We'll be talking about some of the commentary around the Federal Reserve leading into Jackson Hole next week. And then we also have some commentary around AI by Micron's CEO, as well as Michael Burry coming out to, well, continue to be a bear around the AI trade. And he says that he's I think there's this article that came out that said that Michael Burry flags a new AI bubble risk. Let me see. Yeah. So the title of the article is actually GDP growth is really counting on data center build out. All right. And then on top of that, of course, we also have the CFTC coming out and actually saying that, you know what, even if we do not get the Clarity Act passed, they might just go ahead and, you know, even if it doesn't pass, they will actually set the framework, set the regulations for the crypto industry. So I believe the Oracle evaluation. Sure, we can look at Oracle later on. Like I said, I haven't always been the biggest fan of Oracle. You can even see in the debt markets that the credit spreads for Oracle is widening. So I think they're paying what six. I believe the last I checked is like either 14 or 16%. Um, and I don't like it that 50% of their RPOs actually is dependent on OpenAI. And let's say, even the best case scenario, which is that OpenAI makes its payment, but perhaps not in a timely manner, that means their revenue recognition gets stretched out. Then obviously their valuation and the stock price will get affected as well. So um, I'm not opposed to having exposure to uh, companies that have debt. Uh, I mean, as proven by my core weave position, but I am concerned when the debt and the future revenues is really dependent on one or two companies. I mean, in a sense, I think Nvidia, in a way, at least people are saying that, oh, Nvidia uh, also has concentration, right? Because I think 70% of their revenues come from I think the six hyperscalers. But you are talking about the hyperscalers in terms of cash flows. They have billions or trillions of dollars of cash flows. Granted, those have turned negative recently. Just sold my DGen 3.5 calls I bought on yesterday up 200%. Nice. Let's see. Let's see. What's up with the markets today? Give me a minute. Uh, I will pull up Oracle for you, and then we'll talk about that later on. Oracle. Where is the earnings release? All right, over here. So we'll talk about that later on. BMNR finally moving, yes. And I am not. I'm being a little bit careful over here, not to just go out and extend my covered call. Right now, because my covered call for BMNR is actually $23, which we were there in the pre-markets. So I wouldn't count us out reaching that level soon. So yesterday, Okay, I'll talk through the portfolio numbers and then we will go through some of the macro themes. I think S&P up 0.25%. That's good, but you can actually see this is not a broad rally. Earnings in September. Yes, I'm going to be looking at the June quarter, the June report, right? I think for the markets right now, there is still a little bit of jitters around. I think Jackson Hole, obviously, and with what Scott Bessent has tried to do with the treasury markets, obviously not working. I think markets have the right to be worried, and what we are seeing right now is that the Nasdaq seems to be rejecting off the or breaking down past the 50-day moving average. Actually, the crazy thing is that my BMNR is now just $5 from breaking even, $5-ish, maybe, yeah, closer to 6. Never thought I would see that day so soon. At least never thought I'll see it in 2026. That's for sure. Um, okay, let's see what's happening with the position. SoFi, again, like I said yesterday, this turned out to be a pretty good bounce by SoFi. Yes, it came down, but it bounced off the 50-day moving average. And 2 days prior to that, it retouched the top of the wedge over here. So this wedge is very long, and bouncing off this makes a good structure for SoFi in the sense that they can at least they can go and try and test the $19.30 range again. Now, the real question, I don't think it's 1930. I think it's sorry, it's not this. I think it's 1930. Is it 1930? Yeah. That's about the 50% FIP, sorry. So I think if they break past this, I think what is likely to happen is that we're going to see them reject off the 200-day moving average. Like, generally, unless the momentum is very, very strong, like what we're seeing right now. But even BMNR is rejecting off the 200-day moving average. So we might see that with SoFi as well. So don't be surprised. The reason why I place my covered calls at the strikes that I placed them, both SoFi and BMNR, I have covered calls at $23. Usually because $23 is just after some sort of major resistance. So the reason why I've done $23 on SoFi covered calls is because if you take a look over here, we have the 50% FIB, that's one resistance. Second resistance over here, the 200 MA, and then you still have the 0.382 at $22.50. So I think for SoFi, by 18th of September, that should be quite safe. In terms of Bitmine, similarly, even if I were to draw it from here, I don't usually use I didn't use draw all the way from the top because I believe that was really just driven by momentum of Tom Lee coming on board. But if you look over here, this is the long term. We're not even at the first FIB level yet. So I think, firstly, we're going to have trouble breaking past this. Then we might trouble breaking past the next FIB level. So $23 is a little bit risky. The reason why I put $23 is because $23 is above the 200-day moving average. So yeah, barely above the 200-day moving average. So that was a little bit risky because at least so far you have 3 different layers of what. But again, like I said, this really depends on where you start drawing your FIBs. If you're looking at the more short-term trend, then perhaps you can actually make an argument that there is another level above there. NVIDIA CDS blowing out as well. Oh, I mean, I haven't paid attention to NVIDIA's one. I think that has to do with the Ohio data center. I think the backstopping that for 500, it was $5 billion. I can't remember what was the number there. Okay, but we are seeing Bitmine take a little bit of a breather. That is fine because I think all of this is really dependent on the price of Ethereum. And for those of you who have been here, this red line has been our line in the sand for the longest period of time. I've said bounce once, twice, 3, 4, 5 times actually. Because if we zoom in at this period, we tested it once, twice, 3 times in this stretch of between April 2026 and May of 2027. We tried it 3 times during that period, and yet we still couldn't break past it. So it is not surprising to see Ethereum get to 24.45 and then come back down. So, like I said yesterday, in terms of the RSI, we are overbought. Does it? And just to be clear, I'm not saying that as long as something is overbought, it has to come down. That's not what I'm saying. But the fact is that it is overbought. We are at some pretty strong resistance. It wouldn't hurt to see a little bit of a pullback for a better structure. I think if anything runs up vertically, I think when it comes down, we can also expect it to come down vertically. So I would prefer for Bitmine and Ethereum to really take a step upwards. NVIDIA CDS. Okay, from what I see, NVIDIA's 5-year credit default swap, how much are they now? Let me see. They're at around 6% from what I'm seeing. Yeah, from what I'm seeing, they're around 6% now. Previously, they were closer to 4.5%. Was it? Yeah. But these have extremely long maturity. Wow. Okay. All right. Let's continue down the line and see what's happening. So we know the story with Bitmine. SoFi, like I said, we are waiting to see whether it can break past the 50% FIP. Of course, all our hopes is that yes, it can break past the 50% FIP, but it has tried and failed on a couple of occasions. So I am not holding my breath over here. Right. Again, this is just the first half an hour of markets. So far up nearly 6% on the day. I think at one point it was up 6%. It was just 1913, right? But I think the portfolio should be, yeah, the portfolio at all-time highs. Give me a minute. Yeah, portfolio is at all-time highs. I need this for the folks on Instagram. I'm really trying to get better at like posting on socials. In general, I'm not someone that use social media a lot, like normally in my day to day. So on X, on Instagram, I'm trying to get better at it. Okay, so account is at 137,000. I mean, I think I've spoken about this previous times. The way that I structured the covered calls on this account is that if all my covered calls get assigned, this account will be at $170,000. Which wouldn't be too bad. I don't think anybody can say that a 70% gain in from the beginning of March until now is a bad return. So that's so-called my worst case scenario. Best case scenario is the one where I want to keep a hold on to my stocks, and then that means anything below 170. So even at 137, we can be at all-time highs. Maybe one or two covered calls come a bit under a little bit of pressure, but that's about it. All right, so we have CoreWeave currently around $89, not doing much, basically flat on the day. Yeah, Zeta also flat on the day, but Zeta again has been bouncing off. Zeta has bounced. Sorry, not has been bouncing. Zeta has bounced off the 0.618. So if they do convert that into some sort of support, then I will have to. I think what I will do, depending on because my Zeta covered calls, they are expiring on 4th of September, so that's in 2 weeks' time. Okay, So here's the thing: I receive $1.05 of premiums for these Zeta calls. So $1.05 puts the price at the adjusted price would be around $28.05. So I think at $28.05, what it makes sense to do is just if it gets called away below 28.05 but above 27, I'll just let it get called away and then I'll just buy back immediately. Right? Because I already received $1.05 and then my shares are being called away at $27. In effect, I would have been selling my shares for 28.05. So if Zeta hovers around this 0.618, it gets called away at $27, I will just let it do so. I will only defend it if it gets above 28.05 by 4th of September. Otherwise, I'll just let it get called away and then I'll buy it back immediately. I think in terms of managing capital, that makes the most sense. Robinhood up 14% on the day. Is there news on Robinhood or is this just from crypto? Was there any upgrades or any news? Robinhood news. July metrics. Let me see. Do I think ETH will be hitting all-time highs soon? I think we need to break above 2,400 before we can see all-time highs. I think my heart would say that maybe we break above okay. If I'm just looking at this purely from a technical basis, not talking about adoption and things like that. If I'm looking at this purely from a technical basis, you can see you basically have not much really holding ETH below, I would say, this range. So you do have a little bit of resistance at around 2,800 to 3,100. This $300 range could be a range that we find ourselves stuck in. So if we break past 2,400, this range here between the 0.382 and the 50% FIB, that's where we might find ourselves stuck in. My inclination is to say that that's probably where, if we best case scenario, we get a breakout and then we base around in this area. To get back to all-time highs is not that much harder from there because we basically came straight down. If you take a look here, so like I said, if there's no real base being formed, usually you can get back to that price quite quickly as well, which may or may not be a good thing. You can call this bouncing, but this didn't happen for very long. This basically just happened for 2 weeks. So I'm looking for more of something like this where there's real bounce and then coming back up, bounce back up, rejected, bounce back up. This area here between 2,800 and 3,200, this $400, $300 range, I think it will form the next resistance zone. So do I think Ethereum will get back to all-time high soon? My heart says yes. Logically, when I look at it, I would think that first we need to talk about breaking above 2,450, right? Once we can break above 2,450 and hold above 2,450, the next range that we are looking to recover is between 2,800 and 3,100, that $300 box. I think it's because of Bitcoin. Yeah, they released their monthly metrics as well. I saw some news around their monthly metrics. Am I? No, this cannot be their monthly metrics. They released their monthly metrics on 12th of August. That was last week. So yeah, like you said, could be Bitcoin. Could be purely because of Bitcoin. So that's Ethereum. So, and in terms of Bitcoin, we are seeing something similar. Bitcoin strong move. I think the real test is over the weekend. From this, it looks like there is a chance we get back to the 80. What is this? This 84,000. There is a chance we get back there. It depends on momentum. Like I said, both Bitcoin and Ethereum has been extremely, extremely overbought in the last couple of days. Can we get to 85? I would say yes, but I don't think we break past that. Yeah, I really don't think we break past that. Hmm. Sorry, give me a minute. What did I by accident? Yep. Yeah. So basically, for Bitcoin and ETH, I think the story is more or less the same. Has already been overbought. I'm not sure whether it still has legs to run. Uh, 83,000 maybe over the weekend, but usually liquidity is a little bit softer over the weekend. So whether or not it can maintain, even get past this $80,000 level remains to be seen. Okay, again, to me, this is, if this continues to stay so high, there is no way the economy doesn't slow down. So US 10-year back at 471, not what you want to see. US 2-year, 421. I believe this is what they call a bear steepening. Am I right? Like the 2-year, 10-year. ETHA, again, this is very much like the BMNR position. In terms of ETHA, it did break over the 200-day moving average, but this area has been a very strong support for a while now. So seems like it's getting rejected off here. Nvidia down 0.25%. I don't know. I think in Nvidia's earnings next week. I don't know. There is a part of me that thinks that, okay, no, I definitely think that from a numbers perspective, they do well. The question is how much of that is already priced in, right? So I think a lot of the enthusiasm over the last couple of weeks might get faded out across the next couple of days leading into earnings. I think we retest the 50-day moving average. After that, whether we bounce from there or continue to find another leg lower down to the 200-day moving average really depends on earnings and future guidance. But I mean, as always, Nvidia has always been pretty bullish. It's just that the market has already more or less priced in what it has to price in, so it doesn't really move on Nvidia's earnings. You have Broadcom at 366, kind of getting a bounce at the 200-day moving average. Every time Broadcom touches the 200-day moving average, there is always a bounce, except for this time during the beginning period of the war. We saw it come down a little bit. But again, this is not that long. This is just like what, 2 weeks worth, staying below the 200-day moving average. And then we saw a move up to 494. Same thing after their earnings, came crashing down, touched the 200-day moving average, not breaking through, stayed there practically for the entire 2 months that followed the earnings. And then now we are seeing another retest at 367. Taiwan Semis Force 18, ASML 1750, Qualcomm 160,000, 160. Okay, let's take a look at the Mac 7. We have Google. Google is very, very close to where I first sold it. I think I first sold Google around 320. So we are pretty close to that level again. And since then, a lot has changed. So, it would make sense for me to want to look to dollar cost average. Like, I think for me, if you ask me, of all of the Mac 7, the one I feel the most comfortable holding for the extremely long term is actually Google. I think because I use their product the most often, followed by Amazon. Okay, Microsoft 484 today. It's fine. Apple 307. Have you seen the videos recently around the Apple iPhone 15? Like people are complaining that it overheats, and yeah, and we do have an iPhone 15 at home, and it really does overheat. So I'm not too sure whether or not they are actually doing anything about it, because the iPhone 15 that we have was completely fine all the way until we bought AirPod Max. And then when we bought AirPod Pro Max, we had to update the phone, and then that's when the overheating started. So, and I know that there's not much change between 17 and 18, but if we have to buy a phone, we have to buy a phone. Right? And the color looks nice, black as well. Tesla 357. Okay, so we have kind of recovered. You see, the thing about gap closing is that it makes sense as a trade. So if you had bought Tesla at 297 for the gap close, you have gotten your gap close. But usually this shows that there is weakness in the stock, and unless there's some change in the fundamental thesis, a lot of the times this gap close gets sold off again, and then from there it slowly starts its climb back up. SpaceX 132, nothing much to see over here. Oracle 145. So it's 114 the bottom. Oh, I really don't know. I really don't know enough about Oracle to say that to say confidently that 114 is the bottom. And I'll be honest, because of the RPOs and how the allocation of the RPOs are, I've always been a little bit cautious over over Oracle. Okay, so apparently we are seeing on Bloomberg that Trump has a $440 million war chest for the Middle East. Correct me if I'm wrong, but 440 million is a lot of money, but in terms of what he has been spending on the war so far, 440 million is not that much. I understand that it's already in the billions. Okay. Okay, so there's a piece on Bloomberg. Let me see if I can pull it up. This is an interesting piece. Besen wasted no time in undermining the Fed. This is exactly our discussion yesterday. Let me see. Besen. Okay, let's take a look here. This is by Barron's. I think the Bloomberg one is a paid piece. So I'll just show you the Barron one. Uh, Similar take. Okay, so this post talks about Besant having his triple three plan, increasing gross GDP to 3%, lowering the budget deficit to 3% of GDP, and growing domestic oil production by 3 million barrels a day. Focus on lowering the 10-year to 3%. Yeah, I mean, the 10-year at 3% would be fantastic. And for a while, we nearly got there. We were at what, 3.8, 3.9%. So I don't know. I, I I I still hold on to the view that the this administration kind of got oversold the idea of the war being easy. And so now they're trying different ways to walk back whatever happened and the implications of the drawn out war without taking an L publicly, at least. The latest GDP was okay. So okay, this doesn't look good. Latest GDP reading was 1.5%. Deficit risen to 5.8%. I think if you want government to stop spending, I think it's quite hard. But I mean, I think Singapore's government isn't overly spendthrift. So that, yeah, I can't say every government is like that. 10-year Treasury yield 4.7%. Yeah, so basically he's on everything that he wanted to do. They're supposed to announce this sometime soon, right? We went from epic fury to economic fury. We're going to apply measures like have never been seen in the history of economic isolation of a country. Mm, okay, you can see over here. To be sure, Basant was never going to be the traditional Treasury Secretary, as Trump was never going to be a traditional president. He is behaving and sounding less and less like a Treasury Secretary at all. At best, he serves as the macro trader he is, as seen in his recent foreign exchange intervention. He's talking about the yen, and he's doubling this week of longer term bond buyback operations to $4 billion. At worst, he sounds like a political shield and a Secretary of Financial Warfare. Okay. Yeah. I think that I really have no idea why he decided to do that. I feel like Scott Bessent might have come under a little bit of pressure from on top, to actually do something about it, because he doesn't strike me as someone. I mean, considering who he works for and his track record, I don't think he's not someone that I consider completely ignorant of markets. Like, he would have known that these interventionist policies are usually not well received, and as we are seeing right now, all of them usually just get reversed by the markets naturally. They all get reversed by the markets naturally, so there's really no point. Just let the markets take care of itself. Okay, we're seeing CoreWeave down 2%. Like I was saying, this is really a whole stretch of red after fantastic earnings at 117. If you did not trim here, it's okay. Because I think this actually shows that there is some level of support over here between this area. So the first level of support yesterday that I was talking about was this 50-day moving average. But since we have broken down, I think the support will really be at $85. This has been pretty strong resistance and pretty strong support every time we have gotten to this area. It has really been a magnetic area for CoreWeave. I don't expect, like with the strong numbers that they have just shown, I don't expect CoreWeave to really stay here. But with interest rates rising, then of course all of these companies that rely heavily on that, they are going to get sold off. So this is just something I feel like every August in the last couple of years, something happened. Like shit always hits the fan sometime around this time of the year, and then it extends for a while. So perhaps this high yield is going to lead some volatility, and then we're just going to lead into volatility for the midterms, and that's basically going to be the next couple of months. If that is the case, we just have to brace for impact. Really, there's nothing much we can do at the moment other than hedge part of your portfolio. Let's see. So yeah, the rest of the companies here, they're doing decent, not fantastic, but yeah, I don't think it's too red today. I would say that today is more flattish than red. The SPY is now just up 2.3 from the 0.5% earlier, and the Q's just down 9 basis points, which is basically being flat on the day. Right, in terms of AI application, you have Dynatrace, which we were talking about yesterday at $48.60, down around 1.2%. Palantir down just around 10 basis points. Rubrik, Tenable, Arcamine. Again, this is one of the names that you know that we are looking at. Yeah, Zeta holding steady 47.80. Okay. Hmm. All right, I'm going to show you this take by, I believe, who is it? Mark Newton, is it, from Fundstrat? Yes. And then let's go from there. I think people can't really decide whether or not what Scott Bessent was doing is good, and so I think people have different uh, reactions to that. So let's take a look at what Mark Newton has to say, and then we'll dive back in again.
Rates could send stocks to new highs as soon as next week. Mark Newton is Fundstrat's head of technical strategy. He's here at Post 9. It's good to have you back.
Thanks, Scott.
So this was that significant that you think the S&P, the Qs, equal weight leading into Jackson Hole? Like we've got a little bit of room here?
I do think it's a game changer.
Really?
I think we need to see the extent of what they're going to start to buy in terms of securities and how much. And a lot of that has to do with probably the Treasury put, which is now at about 475 for 10-year, potentially 530 for 30. So, in general, it's a hugely reflationary trade that does address liquidity concerns. We saw gold, we saw Bitcoin surge. Near term, the 1-2 combo of rates pushing back up along with crude is temporarily something that stocks don't like. But I think in general, the amount of breadth improvement that we've seen in recent months, along with this ongoing skepticism, is definitely a positive with regards to stocks.
The messaging alone from Treasury is enough to get us to where you think we can go. I mean, combined obviously with the robustness of earnings, right? I mean, that's the story.
The one big problem was that the velocity of rates had really gotten out of hand on the long end. We saw breakouts on the 30-year, we saw breakouts on the 10-year, and it wasn't the level, it was the velocity of that move.
Yeah,
I think the administration as well as the Treasury noticed.
Yeah.
So my thinking is that they're stepping in now at a time when TLT puts Q is very elevated to say, look, we have to do something to help liquidity. Emerging market currencies are falling. The U.S., of course, has a huge balance. They have a ton of overseas securities and emerging market currencies. Meanwhile, their liabilities are in dollars. It would certainly help them to have the dollar go meaningfully lower at a time when growth remains still pretty decent. And that could actually decrease the debt to GDP that everybody's concerned about that now become a big hot button.
Forgive me for interrupting you. It was Rick Reeder who used the word untethered to your point at the long end. It was starting to look that way in his mind. What do you like best in the market right now? What sector, what area?
Honestly, I like three sectors. I like healthcare, I like energy, and I like materials. I think those three are likely going to benefit and be a good source of alpha for investors over the next few months.
Why so?
Well, healthcare per se, it broke out of nearly a 3-year downtrend. We used to have concerns about drug pricing, about the ACA subsidies. Now that has turned. Biotech is surging. We're seeing deals happen. Not only is it biotech, but pharma, but HMOs. Healthcare looks still very, very good to me. Obviously, the GLP-1 helps some of these other pharma stocks, but energy, my thinking is crude is going to revisit $100, which is going to make ending the war probably tricky in the near term.
Wait a minute, isn't that a problem then for stocks?
It could be a problem in September, October, yes. So I think it's going to prove short-term only, but we have one big final push up to right around 100, 110, and then crude should end the year down near the lows. So I think there is going to be an eventual solution better than what we're seeing now, but we know that they're using pipelines to take oil right now through the Red Sea, through the Gulf of Oman. We don't necessarily need to have the strait as much as we did. Already some traffic is starting to be circumvented, but energy right now is very much a short-term long, along with materials. Commodities surged yesterday. I think that's going to be an ongoing theme, just given what we've seen with real rates hopefully starting to pull back, which would be a source of gains for most metals, precious and base.
All right, we'll leave it there. It's good to see you again. Mark Newton of Fundstrat, the head of technical strategy. Up next. Welcome back.
All right, so you can listen to what he said. At least to him, I think he doesn't sound like Mark Newton doesn't sound too concerned. And really, it depends on which side of the fence you fall on. He says that the administration, the Treasury, did what they did because of the velocity of the move, not the level of the move. So he's basically trying to suggest that, you know what, hey, maybe they are really trying to protect against the how the kind of shock that could happen when we see a breakout of the yields, and not because of the level at where the yields are at. So that is his argument, and he thinks that because of that, stocks may still have a little bit of room to run. Again, we'll see how that goes. I think from now until Jackson Hole next week, we are going to see a little bit of volatility. Then after that, when asked a bit further about what he sees as opportunities in the market, he basically lists healthcare, energy, as well as materials, which I think is interesting. I mean, for me, the healthcare trade, not something I'm looking at right now. I mean, I've already exited my healthcare earlier on in the year, around April. So I'm not looking to get back in again. I already deployed some of that capital. But energy is something that I'm definitely looking at. He's probably the third. Like, I've spoken to two fund managers plus Mark Newton now. Is he really a fund manager? He's a technical strategist, right? But he's the third person in the last week that told me that they see oil getting to 110, 120 again. So okay, in this exact interview, he said 100, I believe, to 110. Yeah. So I think we are looking at the possibility of oil getting to those levels again. And like he said, if we do see oil getting to those levels, then perhaps there could be some pressure on stock, which is why he's saying in September and October. So I think general consensus, and this is where you have to understand how the markets work. This is general consensus, doesn't mean that this is exactly how it will play out, because it's still, stock markets are still made up of humans, and people are going to try and front run each other. So the point here is that he's saying that maybe, we can get another push up in some of the stock prices in the near term. But if the prices of oil goes up, it's going to cause some pressure. Plus the midterms, September, October might be a little bit of a volatile period. So if you listen to what he says, you probably have this window of 2 to 3 weeks for this merry-go-round to continue. And you just do not want to be left holding the bag when the music stops, right? So when does the sell-off into the midterms happen? Really, I think it's anyone's guess. Maybe in the middle of September, when the Senate is back from recess. I think that might be around the time. But the thing is, it's very hard to predict these things because everyone is going to try and front run each other. So that's what he has been looking at, and that's why I've been quite interested in Viper Energy as well as Texas Pacific Land. I think these two companies have been quite interesting for me as a hedge. Where is it? I thought I brought it up. Where's my Texas Pacific Land? Give me a minute. Let me pull it up. Then okay, so if I just take a look at this, if I compare the two of them, Viper Energy is a $17 billion market cap at 9.3 times EV to EBITDA. I think EV to EBITDA makes sense, especially for a company with so much debt on the balance sheet. Total revenue for Viper Energy around $2 billion, and for Texas Pacific Land close to $900 million. Is that right? $900 million? Let me see. Yeah, last 12 months we are at around $900 million. But of course, Texas Pacific Land has much higher net royalty acres compared to Viper Energy. And Q2 production, though, you can see this is why, although the net royalty acres, Texas Pacific has more, but the production wise, Viper Energy is really at 134,000, Texas Pacific at 39,000. Yep, so they get paid on Permian oil without a drilling well or paying for one. Okay, so Viper, Somebody selected every acre Viper owns, bought it with cash or stock, and chose it because its well-capitalized operator was likely to drill it soon. Net royalty acres went from 35,000 to 90,000 in 18 months at a cost of roughly $9 billion. It owns mineral interests under 4.4 million gross acres and no surface at all. Okay, zero employees. Every executive is a Diamondback employee, seconded under a services agreement, and Diamondback Energy owns 39.2% of it. And the same man is chief executive of both companies. So I mean, you can actually see where the synergy actually comes in, why they are so profitable, right? So let's take a look at TPL. Nobody selected TPL's acreage. Texas and Pacific Railway went bankrupt in the 1880s. Bondholders received the land in a trust. 140 years later, part of it turned to be sitting. A large part of it turned out to sit on top of the Permian Basin. Owns roughly 892,000 surface acres, making it one of the largest landowners in Texas, plus royalties under 456,000 acres. Over 114 employees, no controlling holder. Horizon Kinetics is the largest at 15.6% and have been for decades. So this Viper Energy is basically like a spin-off of Diamondback Energy. Right. So if you are looking at energy play, to me, Viper Energy really still seems more interesting. But I'm gonna have to project out their revenues from here, like how much revenue they can hope to receive. I will do a real deep dive on Viper Energy. I think this is the one that has interests me the most. Do I really want to sell covered calls here? Let me just take a look at Viper Energy. Plus, I think the portfolio is not big enough for me to take on so many. Like, okay, I'm not a materials, like I have no expertise whatsoever in materials. So I won't even try to use materials to hedge. Plus, I don't think my portfolios are that big. One of it is like 500,000. The other one is 100,000. It's not that big that I need to hedge that much of the portfolio. VNO. Okay, so Viper Energy has seen quite a strong run since a bounce over here. It seems like this is a level that has gotten rejected a couple of times and acted as support previously. So if I just draw a straight line through, you can see this straight line basically passes through here. So, yeah, maybe we see a quick correction, but yeah, the 50-year at least is evening out. So we're not in, I think that the downward pressure has somewhat subsided, but still we are overbought just slightly overbought over here. If we come down to the low 40s, that's when I will start looking at it. Let's see how's the options chain. It's not a very big options chain. 21st. If you're selling a put at $40, either 40 or 42, right? Even 42, the delta is 0.2. For 0.2 delta, you're getting 42 cents for $42. It's about 1%. I mean, I don't think this, okay, to be fair, I don't think the reason why you are buying Viper Energy is to run an option strategy. It's really not. It's like it is what it is. It's supposed to hedge the portfolio. If I buy 100 shares, that's just 4% of the portfolio. In the event that really oil spikes to over $100 per barrel, then we are protected. Viper Energy should do well as a hedge against that position. But I think apart from that, wise, in terms of evaluation, it is a little bit undervalued, I feel, compared to Texas Pacific. Although Texas Pacific has been around for longer, has a longer track record. Right. So that's all for Viper Energy and Texas Pacific for now. Okay. Let's take a listen to Philip Luck.
Recent rate rally had us wondering if maybe the U.S. could be at risk for a credit downgrade. For more, let's bring in Phil Luck, director of the economics program at the Center for Strategic and International Studies. He was also deputy chief economist. I almost gave you a demotion for the U.S. Department of State under President Biden. Philip, great to have you with us.
Great to be here.
Before we get into the credit downgrade, I mean, I'm wondering how you think this action makes market participants around the world think differently, if at all, about the United States and about our credit if the Treasury is intervening right now.
Yeah, I mean, to the point that earlier panelists discussed, Treasury can clearly buy lower rates for a day or a day and a half, but clearly the fundamentals, the market disagrees with the secretary about what the fundamentals are, and I would happen to agree with the market here. I would also say that to your other point, this is clearly a pattern. This is not an isolated incident now. We've seen sort of a pattern, whether it be the yen purchases or this or earlier last year, there's a clearly interventionist Treasury here. And part of the issue here is the way they think they need to be interventionists, right? So I think this really could create pause for market participants.
How do you think this will make it more difficult, perhaps, for Kevin Warsh? I mean, Kevin Warsh had clearly said that he wanted the Fed to step out of it and to let the market sort of, have a pure message from the markets. And here we have an interventionist Treasury who's buying on the long end, issuing on the short end, and really distorting the whole curve.
All right. Before we get to his answer around how Scott Bessent has affected the Federal Reserve, I think it's important to really understand what he's saying before we talk about the credit downgrade over here. Because I think to him, this is the other side of the coin, right? So to Mark Newton, he is someone who thinks that this was a somewhat necessary action by the Federal Reserve, not Federal Reserve, by the Treasury, because of the velocity, how fast rates spike. Over here, Philip Luck is actually saying if you combine this together with what they did with the yen, this is an extremely interventionist Treasury, and I think markets do not like to see that. So it does affect the work of what Kevin Warsh is trying to do because they are distorting the signals, right? Kevin Warsh is a very free markets person. He has been saying that he wants to listen to what the market has to say. He doesn't want to do too much too fast and then basically react or respond basically at opportune moments when he receives, so-called quote unquote, receives the message from the market. So let's see what he has to say over here. And then from there, let's tie into the potential for a US credit downgrade. Sounds bad, but the last time that the US faced a credit downgrade, I think that was last year, stocks were relatively muted. I think there is a potential for some volatility. Like this could just be a glorious mess if everything comes in together, right? You have higher oil prices, rates continue to stay high, you get the US credit downgrade, plus you get midterms. This could be a perfect storm in the next couple of weeks. But if you just look at this in isolation, the potential for US credit downgrade, because the markets are forward-looking, I think in general, if there's a possibility for this happening, the markets would have priced this in a number of weeks prior to that actually happening. And that is what we saw. Was it in May of last year? When was the last? Yes, I think that's when Moody downgraded the US from AAA to AA1 on May 16, 2025. So what, 1 year ago, right? So I think even if we see a credit downgrade, not the biggest impact, of course, not the best. Because without the AAA rating, of course, your rates will be higher, but borrowing costs will be higher. But I think in general, if you're worried that this credit downgrade would mean the end of the stock market rally or the end of the US stock market, I don't think it has to be that hyperbolic. Okay, let's take a listen to the rest of the video and then we'll wrap it up.
Yeah, exactly. And this is, I mean, I think this is a bit of a bipartisan shift away and towards a more interventionist treasury. But this is, exactly the type of activity that was criticized by Bessent when Secretary Yellen took it on. I think this is really it's a shift away, and I think this makes it obviously much more complicated for Warsh. Again, markets are really looking for clear signals here, in part because of what was just said, which is, if this keeps going, the math just kind of doesn't add up, right? We've doubled our debt in over the last 10 years or so. That almost every single quarter over that period we've been growing as an economy. If you look at the immigration policy of this administration, that puts a brake on the long-term growth of the U.S. economy as well. So, look, 30-year bonds are a bet on the growth and prosperity of the U.S. economy in the long term. We're doing a lot to sort of, have barnacles on the side of that growth.
Hey, Phil, this is not a new occurrence, but it's something that, keeps popping up a little bit. When you think of, Treasury Secretary Bessent, he's obviously a market participant, and now he has a lot of tools in his toolbox that maybe he didn't have when he was at a hedge fund. But when you think about like Microsoft as a credit, investment grade, it's got a higher credit rating than the United States of America. What sort of pressure does that put on the buying of treasuries and certainly, long-term credit when you have the ability to invest in things like that, for all intents and purposes, are well situated, as far as the economy, as far as, their kind of footprint as it relates to, AI and such?
Yeah, absolutely. And the other point I would say is, look, if the U.S. economy was just a company and had its balance sheet, I think its credit rating would be quite a bit worse, right? So it's, even in that sense, I would say, look, that's another aspect of this is not only does the Treasury sort of have this really huge demand, it's going to be publishing a lot of paper, that the market's going to have to soak up. So are private markets, right? We're seeing this huge increase in sort of issuance from the private sector as well. So, that really also is going to put pressure on the Treasury market. And that makes sense. We should be getting capital to its most effective use. If the U.S. government and the Federal Reserve really thinks, and the Treasury thinks that's government debt, it's going to have to pay for it.
So I'll get back to the question that we started this interview with. I mean, do you think that the U.S. is now in jeopardy of a credit rating downgrade from one of the major three agencies? Because of the mounting fiscal pressures, obviously there's not much bipartisanship anywhere in the country at this point.
Yeah, I'm much more worried about sort of just the market reaction than any rating agency right now. I mean, I think for sure, look, the fundamentals of our fiscal depth, our discipline are not good. And so that's certainly, I wouldn't begrudge that sort of assessment. But again, I think the broader issue here, and taking this from sort of a foreign policy and national security standpoint, look, the national security, economic security is a big discussion these days about supply chain resilience, all these things. And often what we're doing is we're going to pay for those things by borrowing a lot of money. And what I want to point out here is that there's a lot of lack of resilience and fragility coming in from being that indebted and being in a position where you really could have a lot of issues if we see a downgrade, right. Which again, may very well be warranted.
All right, so you can see, I think in general, the opinions are relatively split. Okay, I would say split because maybe that's what CNBC is trying to portray. To be honest, I hear more bearish takes than non-bearish takes. So I think we really have to see how the market takes in everything, and I think that's going to be a very prominent. It's going to be a very prominent feature of Jackson Hole next week. I'm very interested to see what Kevin Warsh says about this. And although the Fed chair is supposed to be independent, I am pretty sure I don't think Warsh is completely caught blindsided from this. I feel like he might have gotten a little bit of a heads up, let's say. Right, so I'm interested to see what he has to say. What's the narrative that they're trying to spin? Because now we are technically only seeing one side of the coin. We're only seeing what Scott Bessent is trying to do. People are worried how this complicates the job for Kevin Warsh, and I do think, and this is the part of the argument I agree. I do think it complicates. I do think it complicates the job of Kevin Warsh. But at the end of the day, is it going to be a big deal? I think usually in the past we have survived a lot of these scares. The worst case scenario is that this turns out to be recessionary, and then the US actually goes through a recession, in which case maybe SoFi will not end up doing so well. The AI companies, those companies with a lot of debt will not end up doing so well, which then, going back to the question earlier about Oracle, that's why I try to invest in companies that have low to no debt. And at least in CoreWeave's case, the way the debt is structured is still relatively safe because they don't take on every single dollar of that debt until they have the facilities online, right? So they are basically taking it by parts. And they have a take and pay agreement with most of, in fact, all of their customers. And really the only one that is, I would say, because a lot of their customers is like Microsoft, Meta, you really have no concern over there because Meta already has shown an indication that even if they have excess compute, they won't cancel these contracts. They'll just take on the excess compute and then just lease it out. So I think Microsoft is in a similar boat. They did say that they're trying to be a little bit more controlled on capex this fiscal year, which means in Q3, Q4 2026. But this calendar year, not fiscal year, because fiscal year they actually start Q1 this quarter, right? So I believe in Q1, Q2 2027, we'll see Microsoft start to ramp their spending on capex once again. So I do not think that the AI build out is over the moment we see a crash. I think the hyperscalers have only just started trying to fund it with debt. Now, I know the article that we covered a couple of days ago, I think, it was about the $3 trillion debt that is off the balance sheet. And I think that part is definitely scary. But in general, if you're looking at it on a company by company basis, most, if not all of them, have the capacity on the balance sheet right now in terms of their cash and equivalents to wipe out a large part of their debt the very next day, right? In a sense, right, within that same quarter, and then get the debt down to a more manageable level. But until that point in time, I think we just have to wait and see because it's going to be very hard. There are so many moving parts in this thing. What are your thoughts on hard assets? I hear there isn't enough copper for the data center build out. I think copper was something I looked into right at the start. But I think I really didn't understand the space enough. I only know one copper company. That is FCX, the Freeport Max something. I can't remember what's the name. And I think they have done they were flat for most of the year. I'm not too sure how they're doing now. They were flat for the longest time. I was looking at them when they were in the 30s. Then I saw that it ran up to the $50 range towards the end of last year, I think. And then basically from there, I stopped following it much. Let me see. Someone was on YouTube talking about it. That's how I even first heard about it. I didn't even find this company by myself. Freeport McMoran. Yeah, it's over here. So it's up. Oh, it's up 5% today. Wow. Okay. But in terms of hard assets, like I am not someone that is particularly inclined to investing in materials like this. I see the upside definitely, but I think you got to pick and choose. Like maybe for a bigger portfolio and you want to diversify in various ways, then yes. But I don't find that my portfolio is so big that I need to I don't find that I need to diversify in both energy and materials. I would rather diversify just by building up a more substantial energy position. And energy is something that I still have some sort of understanding thanks to my university. The problem is that they are looking to cut their debt. They are looking to increase their spending. So yes, I agree. They are not looking to cut their debt. They are looking to increase their spending. What I'm saying is, in respect to the video that we just watched, what happens when the credit rating, when the credit companies potentially downgrade the US then maybe, if interest rates do become higher, becomes more expensive to borrow, then the AI build up will eventually slow down. So for companies that have already overbought, overcontracted, if they have contracts like the ones with CoreWeave where it's a take up contract, they will just end up taking the entire facility and then just subletting it out to someone else. That's what Meta has already shown an inclination to do, right? And then similarly, I believe Microsoft has already said that this year, calendar year, means Q3, Q4 2026, they should be free cash flow positive, but they did not make any specific promise for 2027. So that is something, again, at least for now, Microsoft is trying to toe the line pretty tightly. In terms of the rest of the companies like Amazon, in terms of especially Google, like they have such a large cash position. They just raised $84 billion, which I believe part of it will come in this quarter as well. That I think that they have enough on their balance sheet to be able to wipe out at least a large majority of the debt, so that eventually the interest expense can become more sustainable once again. So I'm not saying that they are planning to do that. I'm just saying when shit hits the fan, they have the ability to very quickly reduce the debt when they need to, because they don't have to pay off their entire debt to zero. As long as they pay off the debt, as long as they stop investing in capex, they will have the cash, the operating cash flows to finance whatever remaining debt obligations that they have pretty easily. I believe the only path out is printing and inflation. I mean, unfortunately, that is the case, which is why it's so important to be invested in capital markets, right? I think if you are, I mean, at this day and age, if you are putting money in the bank, if you are getting fixed deposits and things like that, you are really not protecting yourself. The number that you see in your account might look the same, but 10 years time when you try and take out that dollar to spend, you realize it really can't buy you jack shit. So yeah, I do believe that, leaving your money in the bank, I think, and to be fair, it is not. I think for most of us, we think that this concept is very normal. Like everybody should do that. But I think I don't believe that it's just in Singapore. I think in general, the world hasn't really caught on. A large majority, I would say maybe 50% of people. I'm not talking about people who unfortunately still live in maybe third world countries who don't have access to all these kind of things. Even in the first world countries where people have access to capital markets, a large majority, I would say maybe 50%, in Singapore maybe a bit more than 50%, still have no exposure to capital markets. Yes, I did see that, because they were talking about all these debt holders going in, all this debt, where does it end up? It ends up in pension funds, and it ends up in the insurance companies. And ultimately, if they default, it is these people, the taxpayers, the citizens, who are ending up holding the bag. And then that will definitely cause a recession, right? And I believe if that is the reason for the recession will be extremely long drawn. We might even see a potential kind of like what you saw after the dot-com bubble, like 10 years, no returns. Like flat for 10 years. Hey, Ledger, do you anticipate a drawdown in September and October? Yes, I've been saying that I do expect a drawdown to the midterms. Earlier on, I was just saying perhaps middle of September, but you never know with everyone trying to front run each other. We were looking at what Mark Newton, the technical strategist for Fundstrat, was saying earlier on. He's saying that, with what Scott Bessent is trying to do, manipulate the long end of the curve, that means that perhaps for now there is still some additional short-term upside, but he sees a confluence of events, the midterms being one of them, and oil prices slowly climbing back towards the $110 per barrel level. These two things might cause a bit of volatility towards the end of the year, but if we get more clarity after the midterms, and I think nobody really says this part out loud because I feel like it might not be unpopular on a public domain, but they do not want to like invoke the anger or the negative attention from the administration. What they are all trying to say, I believe, the fund manager from Capital Group that I spoke to, along with Mark Newton, everyone is saying that we expect oil to be lower towards the end of the year. Why do they expect oil to be lower at the end of the year? I think most people are expecting the Democrats to win the midterms. And hopefully, with that, they can restrain a little bit of what Trump can and cannot do in the war. And then we will finally see an end to that. And with that, the oil prices will come down. And I think actually, to be fair, it is actually a very good off-ramp for Trump. He could say, I want to fight this war. I want to get the job done. But these Democrats, they are stopping me from getting the job done. So, you know what? Since I can't get the job done, I'm not going to do it anymore. You're wasting my time. Then he proceeds on to go to the next thing. So that could be a way. It's an off-ramp. It's a win for the Democrats. Oil prices come down. Markets rally. That could be the Goldilocks scenario that we are looking for at the end of the year. My theory is that all these data centers are going to be used by government for massive balance. For example, flock cameras and analysis automobile driving statistics then used against us. Yeah, so in this portfolio, I am 10% cash. In my bigger portfolio, I'm 15% cash. So I am still waiting for a little bit of a dip. I'm not like fully allocating everything in. I do think I'm expecting seasonal volatility in September. Yeah. So is all-time highs now, but that's because I feel like at various times during the year, we have had different parts of the portfolio driving growth. So there was a period between April to June where it was mostly NVIDIA, CoreWeave, the semi names, AI names driving growth. And then for a while, the software names took over. Then it's all oscillating between the two. And right now, as the semi names kind of take a little bit of a breather, you can see over here, CoreWeave down 1%, NVIDIA down around 1%. What we're actually seeing is the software names, 1%, ServiceNow, Zeta up 1.6%, but we actually have the financials, SoFi, BMNR up 5 and 4% respectively. So at different points during the year, the portfolio has been carried by different sectors, which is why I think, I think rather than in the past, I've always tried to chase different sectors because I find the stock market interesting. I want to know so much about every single company, but I realize that not every single company needs to be in my portfolio, right? If a company needs to be in my portfolio, just because I'm interested in it doesn't mean I have to go and buy the stock. I can just follow it. And I might have, I might, maybe put it in for a short trade, but in terms of a long-term hold, I need to understand the company a lot more deeply. So that's where I consolidated into just these two major sectors, which is AI tech, and as well as fintechs, and then that has worked out pretty well. And if we see a drawdown, what are the top 3 stocks I am loading? Oh, wow. Good question. Okay, so I think it depends on how much capital I have. In terms of top 3 stocks I am looking at, of course, it depends on how big a drawdown we have. I would love to add a little bit more CoreWeave for the short term. I think I said yesterday, I'm looking to actually trim a bit of my ASTS exposure. Like, I understand the long-term thesis. I don't know it well enough to really say that I want a very long-term position in a company that is not producing revenue yet. But I do understand the long-term thesis. I just haven't really looked into it. This is really more of a trade for me. So I would prefer to double down into CoreWeave, and I might look into getting a one additional software name. It's basically a toss up between Dynatrace, Akamine, and a bit more Palantir. Okay, Dynatrace, Akamine, and Palantir. Rubrik is a little bit too expensive for me at these valuations, but if they drop back down to, so it depends on the kind of prices that they drop back down to in the crash or potential crash, right? But Dynatrace, Akamine, I can see, like, even if they compress a little bit, they will get to valuations where I feel comfortable with. Palantir is a slightly different. I don't think you can justify Palantir's valuation just by looking at the pure financials. Investment in Palantir, you are basically trying to understand where the world is going to with AI in the next couple of years. You are pricing in that growth as well. I believe they might just come under 100% growth next quarter, which is, very strong compared to the days where they were growing at 13%. So that's why these three are the top names that I will be looking into, and probably the third name might be a bit of a energy name, which is Viper Energy. Let's go. SoFi and BMR are up exactly 4% and 5%. My portfolio is doing decent today. It is at all-time high, so I think we are pretty comfortable right now. Yeah. But if I am actually deciding to move out of CoreWeave, one of the semi names that I'm actually looking at is Lattice Semiconductor, LSCC. So yeah. So those are the couple of names. I am looking to increase my exposure to the AI semi trade. I don't believe that the AI build out is over. Are we bubbly? I think in some sectors of the AI market, yes, but that's where valuations, you have to be very, very picky. I think CoreWeave is a bit of a leverage bet on this entire sector. The debt is a concern, but because of how it is structured, it is not as big a concern as some other companies. And number two, in terms of their RPOs, it's backed by a lot more hyperscalers, a lot more bigger companies compared to, again, some companies like Oracle. So in the AI trade, CoreWeave, maybe Lattice Semiconductor. Then in terms of software, Dynatrace, Akamine. In terms of valuation, if I'm looking for really long term, it would be Palantir. So I think in a sense, it's a little bit dependent on the market conditions at that point of time. Do we foresee more volatility? If we foresee more volatility, then I will be more inclined to buy companies at a better valuation. But if we feel like the markets are making sense and digesting the information, if yields are starting to come down, oil prices starting to come down, then I will feel comfortable buying a company like Palantir, who might be a little bit rich. I don't think if we get a correction in September, October, that Palantir will be trading at 170. I would tell you that Palantir, to me, at around 120 to 130, that's when I will start looking at it again. And then Rubrik, for me, is also, if you ask me of the top four software companies, Dynatrace, Akamine, Palantir, and Rubrik, I would much prefer Palantir and Rubrik. But in terms of evaluation, I'm a little bit more hesitant, right? So it really depends how far they fall during this correction, and then what the market situation is by then. If we are looking to maybe ending the AI cycle because of higher yields causing recession and all that, then all the more you do not want to be invested in Palantir and Rubrik, even after the midterms, for the simple reason, if we do get into a recession, the high beta, high valuation companies, those will fall the hardest, right? So it really depends. That's why I'm leaving my options open. So I have two names: CoreWeave, Lattice Semiconductors for AI. For software, you have Dynatrace, Akamine, Palantir, and Rubrik. And then in terms of energy, I really only have Viper Energy. Yeah, so but maybe I should do one of those videos, my top 3 stocks to buy if the market crashes, things like that. Okay. Oh yes, of course, the American Strategic Petroleum Reserve is at all-time lows. And I think very much like what we heard from Walmart's earnings call yesterday, that when the price of petroleum gets up to $4, that's usually when you see the consumer start to pull back a little bit. And we are seeing similar commentary about this over the last couple of days. So let's jump in. I'm going to show you another. Oops, sorry, you can see I'm preparing for FPL. That's why it's here. Oh, I realized you guys can't see what I'm seeing. My good. Oh, yes, you can. Okay, because I'm sharing the wrong tab. Yeah, FPL. The Premier League is starting again for those who are watching football. Is it this? No, this is Mark Newton's when I close this. I will not let you watch through the entirety of this clip because we already discussed it a little bit yesterday, but I think it's interesting to hear what they have to say.
% yesterday on disappointing U.S. same-store sales. It was the last of the big box retailers to report results. Target, Home Depot, and Lowe's all turning in their report cards earlier this week. Joining us right now with more on consumer spending trends, Michael Zakor. He's the CEO at 5 New Digital. Good morning to you. It's been a mixed week at best, and I'm curious what you make of it. We've talked about sort of how good the overall economy seems to be, but then there are these we've had a couple of moments here where people are raising some questions, especially on the Walmart side.
Yeah, I call it beat and retreat. So all those big names you just mentioned all beat their estimates for the quarter, but almost all of them have seen their stocks retreat this week on a soft outlook going into the fall. And, I think part of it is I was on here a couple of weeks ago and I said that the consumer is finally starting to feel the squeeze. And we got a lot of feedback that people are saying, finally, you've been feeling the squeeze for a long time now. And I think what I really meant was consumers are finally starting to pull back and they're getting a lot more choosy about where they spend and how they spend it. And so I think, we're seeing that move towards off-price, Walmart performing. And yeah, the outlook is a little soft for the quarter, but from an equity point of view, I still love Home Depot, Lowe's, Walmart. Target has some catching up to do. But I think we are at an inflection point going into this holiday season where the consumer is finally going to get more choosy and maybe hold back.
So you
So you can hear what it says. We might get into a time in the fall where the consumers are a little bit more choosy and start to hold back. We are again hearing that from Walmart. And if a lot of these companies are reporting the same thing, if you remember what happened with inflation, it's all of these companies that forewarned us about inflation in a sense, right? They said that they can keep increasing prices and people would still come back to keep buying. So I would take heed to what these CEOs actually have to say. Much of the world's refining capacity has been damaged between Russia and Iran. American refiners are at capacity, therefore gas hasn't dropped as much as oil. Yeah. So I think we are definitely the reason why Viper Energy really interests me is because I do think we are getting into a time of higher prices. I'm not sure if you guys, how many of you guys actually follow Chris and Matt. VG might be another decent name. How much is it today? It's at $14. Yeah, $14 for VG. I think at $14 for VG, you're not getting much of a safety net, right? Maybe you're looking closer to $10, $11. That if you want a little bit of diversification, that could be something you are looking at. But I mean, Chris and Matt has a lot of good DD on Venture Global. So if you guys are looking at a diversification play, that could be another possibility on top of just Viper Energy.
In the bond market and the Treasury intervention mean for the Federal Reserve? Does it put more pressure on them to lower rates? Joining us now, Esther George, former Kansas City Fed President. Esther, great to see you, and great to get your thoughts on this. What is your take? Because even if yields come down a bit, I mean, the issue here is the national debt, it's the deficit, it's the funding costs behind it, and yields are still fairly high, even if they are going to stabilize, let's say, from here because of these repurchases?
Yeah, I think, Melissa, since the last FOMC press conference, we've seen the markets really trying to sort out a number of issues. First of all, trying to sort out the Fed's communication at that press conference relative to the fact that we have elevated inflation in this country. It's persisted for years now, and trying to understand where is the Fed looking at its own tools relative to that. And then you combine the issues of watching the war and how it continues to unfold. It is not settled yet. And that, of course, has implications for oil. So there are a number of things that I think the market is sorting out here that is resulting in the move higher in yields. And of course, we know for our federal deficit, the underlying issue is those are not sustainable. And there is no apparent plan yet for how that will be addressed. And I think until that happens, ultimately, you're going to see that kind of pressure on these longer term yields.
Do you think that the Fed factors all of this in? I mean, we're just about a week away from Jackson Hole, and this is an opportunity for Kevin Warsh to more clearly sort of communicate how he views the situation on inflation. Maybe not actually outline any sort of guidance, but just his thinking. And he has that opportunity. Should he take it? I mean, if you were to call you and say, Esther, what should I do? Would you say, you know what, now's a great time to clarify because the markets are muddied on this, given all the other factors involved?
Yeah, I think it is an opportunity for him. Again, I agree with him. You don't want to be leading the markets and forecasting things that you're not able to forecast. But I do think we all understand inflation has been elevated for a long time. There have been a number of shocks hit the economy, and yet inflation has persisted. And so hearing from the Fed, how do they think about that? How does it align with their current stance of policy? I think is an important message, both to the markets and the public. And I think we got a little bit of a sense of that from looking at the Fed minutes this week, where you can really begin to see where was the weight, what were the things the participants were considering as they made their decisions at that meeting.
And to that point, Esther, I mean, at this point, you know, as you point out.
Okay, before we get to the second part of the video, the one thing I would like to say is that if we do Jackson Hole next week, I think right now the markets are expecting I wouldn't say dovish, but a Kevin Warsh that really is holding his position. He's going to say the same thing as he has said all along. We are going to wait. We are going to see what the market tells us. We are not going to lead the markets. I like what the markets are doing. I mean, I will take the signals from the markets, and then we will act accordingly. I think it's going to be more of the same. But I think if push comes to shove, I think the most dovish thing he can actually say is that, look, there is inflation, but this inflation that is happening right now is not something that we can eradicate just by raising rates, because this is more of a supply side problem. And what does raising rates do? It really doesn't do anything at all, right? It might in fact make the thing worse. Now, he might not go to such detail, but he has spoken about previously that this is really just a supply side issue. So he is open to waiting and seeing. I think if he says that markets feel a little bit more calm, that could be potentially what leads to the rally into September and October before we get into the seasonality of the midterms, and then that's likely when the next wave of uncertainty will come into the markets. So I think we are going to see a lot of ups and downs until Jackson Hole. I think having this high yield, having the Treasury interfere with the yields just before Jackson Hole is definitely making his Kevin Warsh's job a lot harder. But at the same time, I think he's just going to say the same thing. And as long as he calms markets down a little bit, I think I agree with Mark Newton that we still do have room to maybe run for the next 1 to 2 weeks. But like I said, do not be... I think the one thing that I think most of us would have known by now. It's like, don't be too enamored by timelines, right? Because timelines are just projections. If everybody is looking at the same projections, everybody is trying to front run each other, and the timelines will end up being inaccurate. So the best thing you can do, like I said, and I've told a lot of my friends as well, that cash right now is really the best hedge in this market. Maybe a little bit of put buying would make sense on some companies, but you can see a lot of these companies are no longer at their highs. Like if CoreWeave was at 130, buying puts might make sense. But at 85, 87, does it really make sense? Like, how much upside do I really have? So, you could make an argument for that. So I do think you need to buy protection. Should you buy it now? Maybe not. Now is the time to raise cash. You have covered calls. If you are working, you have salary coming in. I think now is the time to be raising cash, to be preparing for any future volatility. Let's finish the rest of the video and then we'll come back to would I buy puts? I will not buy puts on Palantir. I might sell puts on Palantir if I really want to add Palantir to my portfolio. Like I said, I think Palantir for like favorite software companies, Palantir and Rubrik, right? But I am also keenly aware of both of their valuations. If I feel like a market correction could be coming, then those are not names that I would want to take a position in or establish a substantial position in, because if we do get a market correction, the multiple compression will actually take the stock down a lot more. Because you see, it's very simple. When you get a market correction, it's always one or two things. It's either you get too frothy and you get a multiple correction, or you really get a recession and you get an earnings compression. From the looks of things, at the moment, the earnings compression doesn't seem like it's coming. Of course, if whatever we have feared do play out, which is the AI trade unwinding, that would mean that, maybe some of the companies like CoreWeave, some of the companies like Nebius, who have all of this huge backlog, Oracle, for instance, they might not be able to put up the kind of numbers that they need to, and then their margins will get compressed, and then that's when you see margin compression in the AI space. Is that going to happen in the next 1 to 2 years? I really doubt so. I really, really doubt so. Could that happen in the next 3 to 5 years? Maybe, right? I think the next 1 year, 2027, we should be pretty safe. 28, I lean more towards 60-40 that it's okay. Less certain about 29 and 30. Much less certain about 29 and 30. I don't know how people have the foresight to say that 2029, 2030 will be okay. I think a lot of people, every time they tell me 29, 30, 31, those 10 years, 5, 10, 6 years horizons, all of them tell me that it's fine, it's fine. The only justification that they can give is the contracts have been signed until 2031, the contracts have been signed until 2032. But if you have been working, you've been investing for some time, you know that a lot of these contracts can just be broken. So having a contract to 2031 doesn't anything until the fulfillment of the contract. So how much visibility do we have? I think safely 2027, and then maybe likely 2028. And I think at that point in time, then we will have better visibility of 29 and 30. But like I said, the one thing that could really derail this entire AI trade are the treasury yields. Right now, they are way too high. And if that's the case, and if companies fail to grow at the pace that they need to grow, some of the RPOs do not get fulfilled, companies with RPOs that are highly concentrated will be the companies that are most affected. Sorry, that's a very long answer to a short question, but yes, that's how I'm thinking about this entire.
We've been above target for a long time, even before the war. So inflation has shown to be persistent, even beyond the inflation shocks that we've seen more recently in the past months or so. And so I'm wondering, from your standpoint, what has the cost been? I mean, there's a certain cost to not acting and allowing inflation to persist for this long. And at this point, with the shock still in place, with still the underlying inflation persistent, what is the cost of not acting? What is the cost of not acting swiftly enough in your view?
Well, I think there are several costs. Obviously, inflation is a tax on the consumer and on businesses. So it erodes their purchasing power. And that is the primary reason the Fed is tasked with keeping prices stable. The other cost, though, of this patience of sort of living with this inflation is an issue of credibility and expectations on behalf of the public. So I think the Fed has taken great comfort that inflation expectations, as they look ahead, have remained, as they call it, anchored. But those can begin to drift, and they have drifted higher. And so you don't want to lose the public's confidence that you will address this issue and return inflation to 2%. The question is when and how will you do that?
Do you think the Fed has lost any credibility?
Well, I don't see obvious signs of losing credibility, but it's the kind of thing, Melissa, I would not want to test. This is an institution that has long been willing to keep its reputation solid in terms of how it thinks about this, how it communicates with the public. So I wouldn't want to test that foundation of credibility right now by watching those expectations move. And I think that's why if you're not addressing higher inflation with your interest rate, it's really incumbent on explaining why that is the case and what you see in the economy today that gives you confidence that holding those rates where they are is the appropriate stance.
All right. So a couple of things to take away from there. I think to summarize basically everything that we have said so far, I am not in favor of the Treasury actually intervening with the rates. I think markets should be left alone to sort themselves out. I do not agree with Mark Newton that this was a response to the velocity of the increase of the yields. I think this is very obviously them trying to interfere with the markets. Now, by doing so, you are actually adding more risk to the markets because these are things that eventually companies, these institutions that are buying the bonds, they will have to price in the risk of the Treasury picking and choosing the duration of the bonds that actually get to survive and the yields that they'll be paying. So that is with regards to the interest rates use the use of the 10-year Treasury. How does that affect the AI trade? Higher yields means borrowing cost goes up. Some of these companies who are reliant on debt right now, especially the ones that are a lot more concentrated, they do not have as good a financial standing. I am not particularly worried about the hyperscalers. I think we might, worst case scenario, see another 2022 with the hyperscalers, right? Where they overhired. Now, in a sense, they overbuilt. Maybe overbuilding is much harder to a hole to dig yourself out of than overhiring. Overhiring, you can just let the person go. Overbuilding, you're talking about a lot of capital, and I think it's going to take a bit longer maybe to recover. You might not see the recovery in a year, might be an 18-month stretch of volatility if the build-up actually fails and we see that the hyperscalers start to pull back. Now, the upside over here, or at least the safety net that I feel, is that for a lot of these hyperscalers, they are cash rich. Microsoft is that way, Google is that way, Amazon is that way. Meta, I think they are stretching themselves a little bit. Of all the hyperscalers, I think Meta is stretching themselves a little bit, which is also why, in terms of a valuation perspective, they are the most decently valued, but there is a little bit of that risk priced in. Now, why is this important? Because yes, although they may get a little bit overextended on the debt, yes, they may have a bunch of debt off their balance sheet, but should really things get worse, they have the ability to use their cash on the balance sheet to reduce that debt significantly within the same quarter itself, and then to basically have that interest expense run at a more sustainable pace. You don't forget that a lot of these companies, yes, they may look free cash flow negative. Now that's because they're taking their free cash flow, dumping it into capex. But if they stop dumping it into capex, they have a very healthy amount of cash flows to service a lot of these debt payments. So they don't have to pay off the entirety of the debt. They just need to reduce it to a level where it's sustainable, which is basically what Microsoft has been trying to do right now, right? So if they can do what Microsoft did, I mean, you already saw how the market responded to Microsoft earnings, contrary to what Google was doing. What's my thoughts on how this bull market ends? I think the bull market ends when everybody thinks that, when nobody thinks that it could be a top. Now, and I agree with you, everybody still thinks that there's going to be a top. I think that's when there is still room to run. I am meeting people nearly on a daily basis telling me that the market is too frothy, the market is too frothy, the market is too frothy. The moment these people stop telling me that the market is too frothy and they start buying, that's when I know the market is too frothy. Because there's only so long that you can stay on the sidelines before you have to admit that you are wrong, and you just have to buy if you want to participate. But the more of these people that end up buying after saying that it is a bubble, the more likely that we are closer to the end of the cycle. SoFi price targets by end of year and 2027. 2027, I will put together a video on that because I have to look at their 10Q in detail. But I can tell you for 2026, the very simple math behind this, Anthony Noto has already said that we are expecting 60 cents of EPS by the end of the year if we get 2 rate hikes. Now, we already see that the probability of a September hike has fallen to, I believe, 34, 35 cents. So we are not getting a September hike. So having 2 rate hikes would mean that we hike in the, what is it, October meeting, and then we hike again in the December meeting, which is very unlikely. So my projection is that at most we get 1 remaining of the year, worst case scenario. And that would mean that, as Anthony Noto has said, if we get less than 2 hikes, then there is an upside to our earnings, right? Which means that 60 cents is the guidance. They will likely come in at this rate, maybe 61, 62 cents. But if there is a upside surprise in terms of the number of hikes, a downside surprise in terms of the number of hikes, we only have 1 hike or 0 hike instead of the 2 that they expected, then there will be an upside surprise in their EPS, which means then their guidance might move from 60 to 65 cents and they would actually come in at 66, 67 cents. So it really all depends on the macro at that point in time. Now, personally, I think even if you use a very conservative estimate of 60 cents, assuming that they don't even beat their own EPS target, they just come in at 60 cents. Right now, SoFi is trading at a 50 times PE. If you are trading at a 50 times PE, SoFi was trading at a 50 times PE before their earnings. Right now, they're trading closer to 40 times. Even at a 40 times PE, I don't, okay. You see, the thing about this is that sentiment can always change, but my assumption is that if I'm putting up 60 cents, which means I need to put up 18 and 19 cents of EPS in the next 2 quarters, there is no reason for the sentiment to come down. So at the very least, if we are still seeing SoFi trade at a 40 times PE, which is what they're trading at today, at a 60 cents EPS, that would very easily put the floor price at $24. The upside to that is that if we get 65 cents, then we're looking at maybe $26, or even if we get a 50 times PE, which is where they were before all of this volatility, 50 times PE, 60 cents EPS, you're looking at $30. So where do I think SoFi will end at the end of the year? I would say mid to high $20 ranges. We are likely to see an AI product company failure. Yeah, I think we are likely to see that. But it will not be the hyperscalers. It will not be NVIDIA. It will not be AMD. I think markets are just and seemingly going to end green today. Even CoreWeave is up 0.02%. So 2 basis points green. Yeah, but I think it will. The Anthropic and OpenAI IPO, those may also mark the tops for the markets. Right now, we are seeing SoFi get to $19.03. Wow. SoFi at $19.03. So again, we are at 40 times PE. After the kind of quarter that we have put up in the last 2 quarters, which is basically the first quarter where they did not have a triple beat, they only have a double beat. That's Q1. And then basically last quarter where their earnings actually came in lower due to tax expenses. Even then, they are still trading at a 40 times PE. You need to ask yourself, how much worse must things get for them to be trading at an even lower PE? Now, if you cannot justify things and sentiment getting worse, the only thing, like I said, really that can affect them is macro. But granted, if we assume macro is consistent, right? The war is still happening, but it's not like a full-blown war. And at the same time, we see oil prices perhaps in the $80 range. 1 hike or 0 hikes, then I think you can still make the argument that SoFi should still be trading at more or less the same valuation, which is 40 times. 40 times PE times either 60 or 65 cents, you are getting closer to $24 to $26. If you're assuming a higher multiple, 50 times, 50 times multiple, I think a 50 times multiple for SoFi would mean that the markets would have to really, like, I think S&P $8,000, right? So the SPY at 800, that's perhaps when you get SoFi at 50 times PE. 50 times PE of a 65 cents EPS, you are looking at $30-ish, back to near all-time highs again. So I think if you're looking purely from an earnings perspective, I think $24, $26, that is a very safe assumption by the end of the year. But if you are assuming, and this second price target is 100% based on assumption, there's no fundamentals based on this. It's just macro sentiment. As long as the market feels good, S&P rallies to 8,000, SoFi's multiple expands to 50 times, and they put up 60 cents EPS, then you're likely seeing SoFi back in the high 20s, maybe low $30 range. Yeah, you know what? I would much rather, and I really, really hope SoFi actually gets S&P inclusion before any sort of market crash. I believe they need, what, $23 billion market cap in order to get there. So we are basically there once we are above $18. The problem is that SoFi has had problems trying to hold above $18. Now we are trying to retest, if you can look here, we're trying to retest the 50% FIB from the bottom again. We haven't been successful the last 1, 2, 3 times we have tried that. So not sure whether this 4th time will really be successful, but it has really played out like what we were talking about the last couple of days, right? We are seeing a retest of the top of the wedge, 50-day moving average breaks up in terms of a momentum. If we bounce off from here, I said 50% FIB retest. If we broke down, I was looking at buying more at around the 0.618 FIB, around $16 or even $15 over here. Thankfully for us, we actually saw a break up. So now we are retesting from the bottom. Again, this is the 4th retest from the bottom. When I look at this, I ask myself, what else can help SoFi break over? And I really can't answer that question. So let's see. I don't know what else can cause sentiment to increase next week. Yes, they can't hold the requirements. The problem is that they need to hold the requirements for a number of days, right? So, yeah. The bullish scenario would be a positive Q3 in October or so, coincides with the end of the market volatility and all that. You might get a consistently traded value of in the low 20s. Then Q1, then that's when you can look at S&P inclusion. But like I said, I do think that the AI build-out can continue for a while more. I am not as bullish as people saying that it can go until 2032, I believe. I think when I look on X, I think a lot of people are looking at 2031, 2032. Everything is all based on contracts that are being signed, but contracts that are signed in the corporate world, I mean, it's not that hard to break the contracts, right? So, or to even change the terms of the contract. So, like, basically all I'm saying is that don't just look at, oh, they sign a contract for 5 years, means that everything will be safe all the way until 2032. I think that is a bit of a dangerous assumption. I would rather take this on a year-by-year basis, and then you probably have good visibility out, I would say, maybe the next 18 to 24 months. Right, and then finally, the interesting part about one of the more interesting news that came out in the last 48 hours is this: the CFTC trying to create, I would say, quote unquote, create the Clarity Act on its own, even without a vote. The crypto industry will get a market structure rule even if Congress fails to pass the landmark legislation. The head of the Commodities Futures CFTC basically said on Thursday, it's really important that we have market structure. Chairman Michael Selek said in an interview with Bloomberg TV. Let's see. So the chairman said that the agency is weighing a number of potential crypto rules, but it's waiting to see what happens with the Clarity Act. The bill has stalled in the US Senate. We know that. We are looking for a vote in middle of September. Bear in mind that this is just a vote. Let's see. While the legislation is the most surefire way to lock in crypto market structure, the agency has significant authority to act under its existing statute. If we have to use the authority to create rules without supporting legislation, we'll do it, Selek said. In the meantime, the agency is exploring a new type of CFTC regulated platform that will be called a crypto asset market. Should we give up on Amazon? Oh, what do you mean? The last time I said buy on Amazon on this channel, I believe it's $200. It's been up, what, 20% from there still? 30, 20, 25%. No, my math is not mathing. It's up 30% from when I said it was a buy over here. So it's irritating that it has fallen from 290, but I mean, this was a huge jump after earnings, right? So it's normal that this gets faded off a little bit. But usually this is more technical than anything, I feel. These gap closes are quite normal unless you have huge momentum. But I mean, it's unlikely that companies like Amazon have huge momentum. I think this is a natural gap close. If we gap close, bounce off the 200-day, and then likely we are off to the races if we get a bullish end to the year. Like, we really could have a Santa Claus rally at the end of the year. Like, usually we say Santa Claus rally and nothing actually happens. Like, I always feel like I've been in the market for like 9 years, and if you ask me, do I really feel the Santa Claus rally? It doesn't always happen. I feel like it always happens before December. There's some sort of rally. It's not a huge rally. But recently, the trend has been some sort of fear enters the market in like August, September, shakes up the whole market, and then we just rally to the end of the year. And because of that, you don't really see the so-called quote-unquote Santa Claus rally at the end of the year. So I think with Amazon, much like CoreWeave, fantastic earnings, sold off on earnings. As long as it closes the gap, you might look at, maybe it drops to 40 or so. Yeah, that's fine. As long as it's not back at 200, then you might feel like, oh, we are resetting again. But if you got in here, 200, I mean, 260 is still a fairly decent return, considering that this has only been 3 months. I mean, of course, if you have held Amazon for longer than that, I do understand the frustration, especially if you have held since 2025. You are basically holding for an entire year, and you are up like less than 10%. Of course, then that is frustrating, right? But Amazon, the way that they grow is in spurts. You can see that sometimes, like even in 2020, they were flat for nearly 2 years. Of course, they broke down, but then eventually when they came up, it was quite an aggressive move. So again, you might see a bit of volatility, a bit of choppiness, but then when they move, they really move. For SoFi, 40 times PE with a 40% growth. Yeah. You see, the thing is, they are growing their PE at more than 40%. They're growing top line at 40%. They're growing their PE at faster than 40%. So it's less than a 1 times PEG. And the reason why they actually slowed down their, or they actually moderated their net income in Q2 has to do with taxes, right? Nothing to do with the business itself. So that's why they are, because if you do the math, they are looking at probably around 18, 19 cents. So if they just put up, if they do 18, 19 cents in Q3, Q4, and I'm assuming they get to around 20 cents EPS per quarter in 2027, you could be looking at about $1 in EPS by the end of 2027. Right. And if you take a 40, 50 times multiple to that, you're looking at SoFi easily in the $40s to $50 range by the end of 2027. But yes, like you said, all of this is dependent on the consensus of no rate hikes. Right now, that is not the consensus. The consensus is still 2 rate hikes. So, and Anthony Noto already said, right, if there's no rate hikes, which I personally believe, worst case scenario, we get 1. Worst case scenario. That is actually bullish for SoFi, because if in the worst case they get 1, it's still less than they guided for, which means there is potentially upside to the EPS story. Okay, now in terms of the crypto sector, the reason why I am bringing this up is because when you take a look at BMNR this week, I just want to be very clear. Do not expect them to really be going out and raising capital. I didn't say this yesterday because it slipped my mind, but I saw this and I just wanted everyone to be very clear. On Monday, when BMNR was trading at $18.70, they could have used Monday to raise capital. Okay? They really could have raised capital on Monday, maybe on Tuesday. But since Ethereum and Bitcoin ran all the way up, since the rally, they have actually been trading slightly below a 1 times MNAV. Which means although Bitmain has increased from $18.70 to around $23, it's been about a $4.50 swing, they're actually unable to go and raise capital. And SoFi, at what price are you a millionaire? Are you talking about in Sing dollars or in US dollars? It's 2 different numbers. If I'm not it really, it's 2 different numbers. Of course, in Sing dollars, it would be a lot faster. Let's just say that. Yeah. Sing dollars, we were nearly. I don't know the exact amount. I just know that we were nearly there. Nearly there. And then the correction happened. So like low mid 30s. Yeah. Yeah, I'm looking at USD. I'm not so interested in being. Yeah, I really want to see the 7-digit in that portfolio instead. They can issue preferred. Yeah, I do think that that's what they will be doing. I think I've seen some commentary about them issuing preferreds. So that might be something that they do, right? That to raise capital. I think that's a good strategy for them to use without really going out to dilute shareholders. So let's see what they end up doing on Monday. I do think at $78 million, it's getting a little bit thin, their balance sheet. They do need to start raising capital one way or another. You can see actually our price target has been extremely, extremely accurate. We were saying that if we get to 2,400, price target is 24.27. So where are we right now? We are at around 2,300 in terms of Ethereum price, 23.97. Nearly there. We are just off by about maybe $1 or so, $1.50. Right, but that's also because of the MNEF. We were assuming closer to a 1 times MNEF. This MNEF is currently at 0.97. So the model is pretty accurate, I would say. So I'm pretty comfortable continuing to use this to try and model the price of Ethereum and BitMine from here. I think that despite the rally, unpopular opinion, the crypto winter is still not over. There is too many overhead resistance for me to get excited about this. I think in the past I would have gotten a lot more excited. Now, and I look at it, I'm like, oh crap, when is it going to fall? Because I just look at it and I just feel like there's too much overhead resistance for it to be a straight line up, and neither do I want there to be a straight line up. So, firstly, I think more importantly, you can look at this 2400 line. This has been a real pain in the ass for Ethereum. We are having problem getting past it once again. So every time that we have problem getting past that, what happens is that we retest the lower moving average. So again, I don't think that this means that this rally is fake or this rally is definitely over. I think this can be a healthy start for Ethereum, start of the climb, start of the recovery. Although it is a crypto winter, I do not see why ETH has to be trading in the low 2000s. Right? It could still be in a crypto winter, and we could just be basing sideways between 3,000 and 4,000, completely fine. So two things be true. I think we are still in a crypto winter. I don't think this rally has much more steam to continue running because of a lot of the overhead resistance. I also think it is more healthy from a structural perspective. Oh, sorry, I just realized I haven't shared this structural perspective for BitMine to actually come back, retest some of the moving averages. To me, you can see over here, irritating line, this red line, we cannot get over it. That is fine. Okay, we might come back down, retest the 200-day moving average. Yeah. So because of this, I'm not even trimming my covered calls. My covered calls are actually at $23, which means we are just like, 20 cents away. And my covered calls are expiring 18th September. I don't expect us to get above $23 by then. I think we see a little bit of a pullback. This has just been 3 tremendous days of price action. Fantastic. Let's come down, retest the top of the 200-day moving average, allow the 50-day to cross over, and then we can be off to the races. Again, as I was mentioning earlier on in the stream, when I say off to the races, I'm saying we are racing off to the next block over here. This line, 2,800, we have seen this being tested and held as support once, twice, 3 times, 4 times before it finally broke down again. So I would say that this is the area, 2,800 to the 50% FIB. This is going to be the place where likely ETH starts to base. But if ETH is basing around in that area, BitMine should be trading maybe in the mid-20s, right? And I think a lot of people would be a lot more comfortable, a lot happier by then. Because even for me, my average is like $29. So I would much rather BitMine base around in the $24 to $26 range than in the 17s and 18s. So the good thing for me is that I think, the other day I was just ranting about it, but it's not really something I'm too bothered with. I think it worked out nicely. Because I needed some money for the renovation, I had to sell a little bit of BitMine. And my idea was sell the BitMine, get the money, pay off some of my renovation stuff. I'm going to have new money coming in within the next couple of weeks. The moment those money came in, this rally happened. So I didn't get to buy back at $17 when I trimmed some, right? But actually, to me, on hindsight, this worked out well because I still have the majority of my position, still over 70% of my original position is still intact. And now I actually have the capital to wait out the volatility in September and October. I think if I did not do that for the renovation, I would not have. If I would be a little bit more stubborn, I would not have sold. So it was a good thing. So I am not too worried about this, honestly. Yeah, despite me whining sometimes. But as always, I think all we can do now is wait and see, because this has been a tremendously volatile week in the markets. I expect next week to be the same. Jackson Hole will be front and center next week. ETH is at 2,400. Let's see whether or not we break above this line. I am hoping that ETH can end the year between 2,600 to 3,200. That would be fantastic, because if I jump back in over here, and we put ETH at 3,200, we are looking at Bitmain's price of around $32, right? So I think that is a place where all of us would like to be. Okay, and so with that, thank you very much for your time, ladies and gentlemen. I will bring the stream to a close. It's been an interesting week covering the markets. Same thing next week. We'll be live every day around 9:15, 9:30. Today I was a little bit late because I was preparing some stuff, but all is good. I'll see you guys again on Monday, same time, same place. Watch out for a new type of video. I will either be releasing on Sunday or Monday, right? And then you can let me know how you like this new format of video. And with that, I will see you guys next week. Hope your stocks continue to stay green for the rest of the day, as do the markets.